Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman & Wakefield's #1 investment sales team in New York City.
So let's look at some macroeconomic factors though. Inflation, consumer confidence we're going to look at, and consumer spending, the housing market, GDP growth, history and interest rates, and unemployment. You look at inflation, you see inflation is non-existent. 0.09%. I mean, it's nothing. And with all the money that's been printed, with a quadrupling of the money supply in this country, to have no inflation is kind of crazy. Something's got to be wrong with that. So 0.9% is lower than 2008 when it was 0.1%. So in the midst of Lehman and all the crazy things that were going on in that point in time, inflation is even lower today than it was then. So Mr. Burns says, you know what, with everything going up in such a mediocre way, even very, very low yields on commercial real estate is great. I want to keep buying. Consumer confidence and consumer spending. So the Conference Board Index showed that consumer confidence declined in October. It's declined a few months in a row. CEO confidence is down 10% year to date. So the optimists say, well, the decreases in confidence are only really moderate. They really haven't been that impactful. And the trend since 2009 has been very, very positive. So I'm really not concerned. I think the consumer is doing well. If you look at this chart, it shows the Conference Board Index of Consumer Confidence. You see how the trend has been since 2009, pretty much directly up. Even though there's volatility up and down, still we're in a good position. So the optimists feel good about that. But if you go back, let me go back for a second, but you look at the last 12 months, that consumer confidence has been pretty steady. Hasn't really gone up, hasn't really gone down. So that's something that the optimists feel good about, is that things have been relatively flat for the past 12 months. And consumer spending is what has been credited with the second quarter of 15 GDP growth of 3.9%, which was very healthy. So the optimists feel very good about that. However, this is something that I think was probably the most interesting chart that we came up with for this talk. Is a small business optimism index, right? It surveys small business owners, talk about how they perceive the market, how business has been, how they think things are going to be in the future. If we look at that chart, we see that the index is well below the Conference Board Index. And if we look back at the late 80s, late 90s, 06, 07, and now, it looks very similar. So you look at the difference. When the red line, which is a small business optimism versus consumer confidence index, when this gap is big, these gray lines come. The gray lines are recessions, right? So we have the big gaps before the recessions come. But right now we're in a period where that gap is getting pretty big. That's something that's a concern. And that's something that the homers out there are very worried about. Housing market. Homeownership rate in the country, and housing is important because housing is normally for Americans, their home is their biggest investment. They have the most equity in there, and that affects how they spend. Our economy is about 68% based on consumer consumption. So it's very important, but our homeownership rate today is under 64%. Right? It was 69% in 2005. Right now, it's the lowest it's been since 1993. So that concerns the pessimists. It's cheaper to own than to rent in the top 100 U.S. housing markets. Consumers, according to the pessimists, have less to spend because they think that their homes are not worth that much. So they're not going to go out, they're not going to take out mortgage equity withdrawal to finance acquisitions. Mortgage equity withdrawal was something that really helped inflate the asset bubble in 05 to 07. And in fact, in 2007, there was a minus 4% savings rate in the United States. And that was caused mainly because folks said, my house went up in value so much, I'm going to borrow against the house, take the money, go buy a flat screen TV, and that's what everybody was doing. So Homer's concerned that consumers will have less to spend. The optimists say, well, the supply of housing is relatively low, and this year there's projected to be about 1,036,000 housing starts in the country. We need about 1.5 million for equilibrium. And it's not even as close as it seems, because every year we lose about 400,000 or 500,000 homes to natural disasters, fires, functional obsolescence. So we're still way below where we need for equilibrium. That bodes well for the housing market. Housing market has gone up 25% since 2011. It's gone up 6% in the past year in real terms. Real means it's adjusted for inflation. 6% is actually great, because if you consider that 1998 to 2005, the average appreciation rate of housing in the U.S., 6.8% in real terms. So the optimists feel very, very good about those numbers, but the pessimists say, yeah, but you know what? People owning homes may be a thing of the past. Millennials are not buying homes. They want to live in cities. They can't afford to purchase in the city, so they're renting. So if you look at millennials now make up a greater component of the labor force than either the Gen Xers or the baby boomers. And if you look at their percentage of the total population, they are increasing in New York City. They're heavily concentrated in Manhattan and Brooklyn. But these folks have something that's an anchor around their ankle. That anchor is student debt, right? And if you look at the next chart, there's an inverse relationship between student loan debt, which is the green line, and the home ownership rate of these millennials, which is the blue line. So the arguments that are made that there are issues with student debt and how impactful that is, this is a very, very impactful dynamic, and leads the pessimists to say, you know what, there may be some structural issues within our housing market. GDP growth. Homer's concerned. Second quarter was only 1.5%. Past 4 quarters, it's averaged just over 2%. Here's a GDP by quarter graph showing that it's been very, very volatile. And importantly, if we look at the previous 4 recoveries we've had, GDP growth has averaged about 3.8%. This recovery, just over half of that at 2.2%. That's a concern, and something that the optimists will say, well, it's pent up, it's going to accelerate, we're going to be fine. The pessimists are concerned that the economy is not moving the way it should. So if you have growth, basically the definition of a recession is negative growth for 2 quarters in a row. But if you have GDP growth at less than 2%, you feel as if you're in a recessionary period. So that has the Homer's concern. The optimists say, but we're positively growing. It's better than some other places, so don't worry about it. It's all relative. GDP per capita is higher today than it's ever been at $46,000 per person. 18.1 trillion as our GDP is the highest it's ever been. That's positive. So the optimists in the room look at those things and say, you know what, everything's okay. Homer then counters with, but our debt is 18.6 trillion, the highest it's ever been and the highest as a percentage of GDP. So there are points and counterpoints to this argument. History and interest rates. The pessimists say, well, economics and history teach us that long periods of low interest rates create asset bubbles. To which you look at this, you can't argue that that's a long period of low interest rates, right? That is just remarkable. For 7 years, the federal funds rate has been hovering around 0. So if we look at 10-year Treasury yields, we see how low they are. I think the 10-year closed at 233, 234 today. This just zeroes in on the last year and a half. And so what Mr. Burns says, the optimist, is, look, the economics books say that long periods of low interest rates create asset bubbles. Well, you know what? Economics books are being rewritten. What has happened in the past doesn't really matter anymore. We've had unprecedented government intervention. And look at what happened with the U.S. debt. August of 2011, S&P downgrades the U.S. long-term debt. Every economics book ever written would say that interest rates will rise. What happened? Interest rates dropped like a stone. all the money printing. If you said to somebody in 2007, said to any economist, we're going to quadruple the money supply in the US, what's going to happen with inflation? There's not one who would come within 10% of the 0.09% that we're actually inflating at. So the optimists say, look, all those old rules, they're out the window. They don't matter anymore. Pessimists say, but the Fed has stopped quantitative easing. Interest rates have to go up. That's going to hurt us. We had all this quantitative easing. The Fed has stopped. Rates have to rise based on what the Fed's actions are. But the optimists say, no, you're not seeing things clearly. The Fed is still buying. The Fed is still buying. How are they buying? They're not increasing their balance sheet. But what the Fed is doing is every time bonds mature, they're going out and buying a new batch of bonds with the same face value. So quantitative easing actually is still going on. The impact that we will have on rates will be when they raise the federal funds rate, when they withdraw excess reserves from the banking system, when they decide to sell some of the stuff they have so they have a net negative position. That hasn't happened yet. So the optimists are saying, look, things are great, rates are going to rise a little bit. Most bankers will say, we can absorb probably a 50 or 75 basis point increase in rates before we have to pass it along to our borrowers. And borrowers only care about what they're paying on their rate. They don't care how much spread the bank is making. So the optimists are feeling pretty good about that. Unemployment, I'm going to look at the October jobs report. 271,000 jobs created in the U.S. The consensus was only 181. That has the optimists feeling great. Now, the unemployment rate is 5%, the lowest it's been in years. And if we look at the number of jobs created, we see that since the beginning of 2010, we've had 13.2 million jobs created in the U.S. We lost 8.5 million jobs during the recession, so we're well ahead of where we were. But the pessimists in the room say, well, the October report really is skewed because the government uses this birth-death model where they're making wild assumptions about how many companies were formed, about how many companies went out of business. Historically, October has been a month in which you've had revisions of these numbers very significantly. So the pessimists look at that and say, well, that 271 is not as good as you think. And the participation rate is only 62.4%. Participation rate is the number of working age folks that actually have a job in the country. That's the lowest it's been in 38 years. And if you look at the fact that while we're about 5 million jobs ahead of where we were in 2007, based on our population growth and the participation rate, we're still about 3.4 million jobs short of where we were in 2007 to have that same feel-good feeling that, hey, things are great. We have relatively good employment. People are happy. Still short, even though we've had all those jobs created. But then Mr. Burns says, yeah, but hourly earnings are up 2.5% over the last 12 months. That's the best it's been since 2009. That's very positive. But Homer responds by saying, you know what, real earnings really haven't increased over a decade if you take inflation into consideration. Mr. Burns, the optimist, says, yeah, but we're in New York City. New York City employment is doing great. And if you look at the numbers, it's remarkable. During this recovery, 533,000 jobs created in the city. It took only 5 3/4 years to get that growth, and that growth is continuing. And compared to previous recoveries where in the late 70s, early 80s, 463,000 jobs. It took 12.5 years to do that. And coming out of the S&L crisis in the early 90s, we formed almost 490,000 jobs. It took 8 3/4 years to do that. So employment in the city is fantastic. And if we look at financial services, New York has generally been known as a financial services city. We've had good gains in financial services, but not quite to where we were in 2000. But the TAMI sector, which is technology, advertising, media, and information, is at an all-time high in terms of the number of folks that are employed in New York City that are in that sector. So New York City employment is looking great. So in this in this fight between fear and greed, between the optimists and the pessimists, who will prevail? And I know you guys are not really big Simpson fans, but will it be Homer who's going to be crying his eyes out because the market is going to recover, or going to recess and reset? Or will Mr. Burns be joyous that the market's going to continue to run just as it did in 1998 when things continued? So one thing I'll leave you with respect to market corrections, whether the market is going correct or not correct, is that firstly, you rarely see the correction coming. You look for signs, but there's usually not something that overtly lets you know the market is going to turn. And the tipping point, the thing that is the catalyst for the market to change directions, is rarely the same. So with that being said, any questions you have, I'm happy to answer.